Welcome to Business Talk, your go-to destination for all things finance, business and investing right here on businesstech.co. As always, I'm your host, Michael Avery, and today we've got a true expert in the field. Joining us again is Wendy Myers, Head of Securities at PSG Wealth. Wendy is an absolute legend in the stockbroking industry, an esteemed member of the South African Institute of Stockbrokers. And Wendy, it's great to have you back on in this series that we've been running, talking about how we should be approaching not only refreshing our portfolios, but from a long-term perspective, the importance of time in the market and the need to weather short-term market fluctuations. And if you just look back over the last couple of weeks, how the market has kind of readjusted to this new rates higher for longer narrative that's come out of the Fed. But for those just setting out on their investment journey, what are the key considerations that they should have in mind?
Well, first of all, I think well done to those investors that are starting out now in contributing towards their financial freedom and their retirement. And obviously a reminder that wealth is achieved by consistently putting money aside for investing. I think I always smile to myself and I think of Warren Buffett. He always said, don't save what is left after spending, but rather spend what is left after saving. I really love that quote. And really, I think the key first steps are deciding how much you want to invest on a regular basis. That's critical. You obviously, to Warren Buffett's point, you want to take action. Choose your platform. Obviously, I'm in favor of trading and investing with a registered stockbroker. There's various benefits to that. One of the key benefits is obviously having access to a financial advisor. But there are other non-stockbroking platforms that are becoming popular that investors can consider. And then I think the next step, and this is an important one, is to choose your investments based on your risk tolerance and your investment time horizon. And this typically means that if you've got a longer time horizon ahead of you, and remember we've spoken about how time is your key determinant in investing and being able to achieve your investment goals, then those investors that have a longer time frame ahead of them can typically structure their portfolio slightly more aggressively and with a bit more risk associated with that investment. But yeah, that's something I would certainly consider as taking first steps towards investing.
Yeah, and I want to come back to that point about using a registered stockbroker, giving you access to a financial advisor, because I'm not sure how many investors beginning their journey are actually aware of that. But picture this: if you're an investor, you're on a thrilling adventure, and your portfolio is your trusty sidekick on this adventure. What are the cautionary tales or the exciting stories that you can share about the common risks that they might encounter on this journey? Because I think it's really important to understand that, like any intrepid explorer, if you know what you might encounter out there, be it snakes, ticks, monsoons, you can prepare for it well in advance.
Yeah, so I think investors should be very mindful of the risks of investing. There are risks to be conscious of upfront. I think market risk is your key one, and this obviously represents the daily change in the share prices due to macroeconomic factors. We spoke about interest rates earlier, Michael, and that the Fed's decision has had an impact on equity prices overseas. These prices have obviously come down in response to the Fed stating that interest rates will be higher for longer. And then counterparty credit risk. This comes in the form of either pre-settlement risk or settlement risk, but typically this risk is removed when you trade through an exchange, as the JSE acts as the lender of last resort. Liquidity risk is the third risk for investors to consider. And generally, if you deal through a regulated exchange, other than if you consider over-the-counter instruments, then this risk is mitigated. And that's really because the exchange acts as a market of buyers and sellers. So certain shares may encounter problems from time to time, but that's specific to the share itself. They may have challenges from a a sector perspective or a strategy perspective. But the exposure to these type of shares can be mitigated by having a well-diversified portfolio. And then the last risk, Michael, to be conscious of is obviously volatility risk, the risk that shares go up and down. We're all very aware of it. But I think it's important to understand that volatility can work for us as an investor. It provides us with the opportunity to invest at stock prices when stock prices offer really good entry points. But that's, of course, on the assumption that you've done thorough research to want to invest in that share.
Yeah, it always amazes me how we, as consumers, we love a good deal. We love a bargain. We love a kind of 50% off end of season sale, or certainly my partner does. But when it comes to equities, when we see certain really good companies on sale, generally because the market has sold off and no shares have really been spared, we hesitate. We don't like to dive in because we're fearful. Back to Buffett and fear and greed and all of that. But let's talk about equities, because I think they're probably the most popular choice for many investors. And what we talk about, we like talking about companies and their strategic decisions or missteps, but they do come with their own set of risks. Can you just shed some light on the common risks associated with investing in equities?
So I think the common risk is really market risk, and that is why I think as an investor, and going back to our point around taking time to understand what your risk tolerance is, I think it's very important for you to be comfortable with what you invest in and how you structure your portfolio. I think when market risk impacts the performance of your portfolio, it's important for you not to take these emotional decisions and follow the herd. So that is why I think structuring your portfolio upfront to meet your risk tolerance is really your first key step in investing. I think an aggressive portfolio is one where is typical for someone who's probably quite comfortable with market risk, certainly have a long time frame to investing. So maybe somebody in their 30s would look at an aggressive portfolio. Probably if you look at mine, mine's probably still quite aggressive, and I've been investing for a long time, but I'm comfortable with market risk. So I'm happy to have a portfolio which has quite a high exposure to equities. Typically, an investor who's a bit more conservative will have a much lower exposure to equities. So those investors who have an aggressive portfolio probably have about 85% invested in equities, and the remainder, 15%, in bonds or cash. I think those investors who shy away from that type of risk would follow a more moderate exposure, and that would be 60% equities and the balance in bonds and cash. And conservative portfolios, those are typically far reduced equity exposure, sort of looking at about 30% with a balance in cash and bonds. And typically, as you progress throughout your investment journey, you probably start off a lot more aggressive, and then as you tend towards retirement, so your exposure to equities starts to reduce. But I mean, it really does, Michael, depend on how you perceive these risks and how it matters to you, and how you decide what you're comfortable with, and that's how you go about structuring your portfolio, given the risks that investing that come with investing.
It's a highly individual factor, as you say. There are general rules of thumb. Yes, you do tend to be slightly more conservative as you head into that period of retirement where you transition and you've got to annuitize. But I guess it's just crucial for investors to understand their own comfort level with risk. And, speaking of a financial advisor, how would they tend to sit down and help individuals assess and align their risk tolerance with their investment goals, given that trading through a registered stockbroker gives you access to a financial advisor?
Well, I think there's two things. I think your goals and needs change over time, and we've discussed that quite a bit at length. But also, as markets move, so the percentage allocation of each of your investments in your portfolio, they come out of sync. So what often happens is you spend time with your financial advisor. If I can guide you to from an expectations perspective, you should sit down with them once a year and really look at how your portfolio has performed, and that is the time to take stock and look at whether it still meets your risk tolerance, and also to say, do the assets in my portfolio, do they hold the right percentages? Should I do a bit of rebalancing? Should I maybe take some profit off the table so that I can reinvest in other counters? Or maybe my exposure to technology stocks that have performed well is maybe a bit too high and I need to rebalance into more dividend paying stocks. So that's where your financial advisor is really best placed to assist with these decisions and set you up for success for the long term.
Yeah, and as we know, offshore has performed quite well. It may just push you from a percentage point of view outside of what your initial financial plan was. So really good advice that. Now, Wendy, you're obviously our investment guru on the show. So considering these potential risks and hurdles, what's your juiciest nugget of wisdom for investors who are eager to strut through the market with confidence?
I think do your research. I think a lot of times, to your point earlier, Michael, we very keen to jump in without doing the necessary research and follow the herd. I think read up, make sure that your financial advisor guides you along the way, but be conscious that you're not just investing for those short-term fluctuations. You want it for the long term, and you know that it's not a one-day game, and that you have to constantly monitor your portfolio, make sure you're invested for the long term, continuously add to your portfolio, and make sure there's some good dividend paying stocks in that portfolio construction that contributes towards your passive income.
Yeah, it becomes so easy once you start. What I find is that discipline, it grows because you become interested in the reasons behind why you're investing, specifically from an equity perspective, and why you've chosen a particular sector or company. And so you understand now the big trends like AI that are washing over sectors and how it's going to impact them. And so it really does become almost like a way of life. Wendy Myers, thanks so much as always for sharing your wealth of knowledge and insights with us today here on Business Talk. A pleasure as always.
Thank you very much, Michael.